Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we got a great show for you today. I'm a little under the weather, so you're going to have to excuse me if I'm muting and coughing and stuff like that, but it's December 10th, 2025. We just had a Fed day where the Fed, of course, as expected, did a rate cut. And to help us walk through this, especially I love having Jeffrey Hirsch at the end of the year. He, of course, is the editor of Stock Traders Almanac because what better way to look forward to 2026 with a little bit of history lessons, right? And what typically happens in the past. So thanks for being here again, Jeffrey.
Pleasure to be with you.
Absolutely. Well, let's get right into it. I mean, if we just kind of take a look at this year, and I'm going to throw up a chart just to remind folks how great it's been. And now, look, it certainly didn't start off great with March and April being very, very ugly. But this is another looking to shape up to be another strong year. Here's the Nasdaq coming up, another double-digit gain. Not anything to complain about there. So what's kind of your take on how this market went? It certainly didn't fit some of the normal seasonal patterns. Is that okay, or what are your thoughts?
It is what it is. There are other factors other than seasonality that impact the market, and when we see the market do what it did, it's an indication that there are other forces that are more powerful at play than seasonality. Seasonality can be a headwind, a tailwind. It gives you guidance, but when it doesn't transpire, it becomes an indicator. I mean, we see the VIX hitting 50 in April with the Liberation Day tariff tumble. Other stuff's going on there. So, it did track the recent 4-year cycle. I mean, we've talked about this before. The post-election year is the best year of the 4-year cycle since 1985, and we got that. I mean, this was in our best case scenario, outlook with 12 to 20% gains. I'm still looking for 20%. I think we're going to get up to 7,100 S&P. I mean, I was talking about a monster rally before we had the little bit of a correction. I mean, which ended up being about 5% in the S&P. So, you see new highs, new all-time highs in September and October, two notoriously volatile and bearish months. It's got to tell you that there's some powerful stuff going on a macro level and a fundamental level, and the technicals show that too. We bounced right off that. I mean, this chart is looking ahead till next year. This is the average 4-year cycle, going back for several years, going back to 49 for the S&P and Dow, and 71 for NASDAQ. And this is telling us that, look for a little bit of a weak patch there in Q2, Q3. Dow and S&P down 2.5%, NASDAQ 6.5%. But everyone's got the old school midterm year thought, bearish thought in their head, and everyone's getting all geared up for a down market. Even in my outlook that I put out in May, I was a little more bearish than I am now for next year. I think we'll get some chops, some sideways stuff, but the Fed easing and the reset of April. I mean, it wasn't a textbook bear market, but it kind of felt like one. And
it felt almost like COVID, like the V-shaped recovery.
or 98, the long-term
98, the long-term capital
there's
management, absolutely.
There's been a couple other of those, and those did register official bear markets by the Ned Davis research metrics that I use. But it may have been the reset, and we may be at the outset of a new cyclical bull market. Remains to be seen with a little hindsight. Either way, it felt rough, and we had a 7-month streak of gains, even though we were down for a while there in November. We came back for eked out a little bit of gain for the S&P, and this is just bullish going forwards. I mean, gains beget gains. We're looking at the best 6 months of the year, November to April. We're looking at a 7-month streak going through to November, and you're looking at potential, roughly 90% chance or probability that we'll have gains the next 3 and 6 months. So, with the Fed easing, the AI super boom in full play, which dovetails off my super boom cycle analysis, I can't see us doing, that badly next year. I don't see us having another 20% year, maybe double digits, probably more in the average year, like the 8 to 12%, which is sort of the average gain, going back to 1950 or so. But the other thing with the midterm year, this is not just any midterm year. This is
Yeah.
the sixth year of a presidency, the second Republican midterm year, which, if you go flip to your almanac, which I owe you a copy, and on page 10, we've got a chart of that. And these particular types of midterm years where it's not, where it's a second, time around are pretty bullish. It's kind of like they got nothing to lose. They're not going to get another year. I know there's been some chatter about that, but I don't buy any of that. But so it's not as bad as the other midterm years. However, we'll probably get some weakness middle of the year, Q2, Q3. Not sure we're getting the red numbers, but there'll be some chop.
Yeah. Well, let's talk a little bit because, okay, you've got this, 7-month streak that you mentioned. You've had a number of double-digit gains, back to back for the annual numbers, and of course, in a lot of people's minds, that just kind of makes them feel like, well, we can't. We can't keep on going up like this forever, and there seems to be a lot of bearish sentiment out there, a lot of negativity. Can you talk a little bit about that?
Yeah, I mean, it's not going to be forever, but
Right.
it's definitely going to go for a while. I mean, we'll probably have some softness at some point next year, but there's the sentiment readings out there, the consumer sentiment readings, the University of Michigan, the Conference Board, the consumer confidence numbers. They're all, negative. They're asking people how they feel.
Yeah.
But go look at the credit card data, and I don't mean the debt that they're building up, but the charges that are going on, and the readings from the retail organization, the National Retail Association. It's just showing they're spending, not like crazy, because I don't want to be, dramatic about it, but they're spending more than last year. We're looking at potential for $1 trillion of holiday sales. You've been out there. I know you're a little under the weather, but you've seen people busy at the stores. I mean, Black Friday, they were interviewing people at the malls around me in the New York area and elsewhere, and everyone's out shopping in person and buying online, and they're spending. So they might say, "Oh, I'm concerned," but they're still spending. They're still pulling out their wallets and spending money. So sentiment and actual spending, and then there's the market. Russell's making a new all-time high. Dow, S&P, Nasdaq closing. S&P is just missed closing above the new all-time high today. So, people can say they're worried and concerned. I mean, there's also the proverbial wall of worry that the market's climbed.
Yep.
But things are, technically, fundamentally, I know sentiment got a little frothy, but it came back. Sentiment can stay bullish for a long time before the market turns. We got the seasonality. I know seasonality was a little turned on its head earlier this year, but there's still the tailwind of the best 3 months of the year and the best 6 months of the year: November, December, January, and November through April. But it's hard for me to get bearish. Be a little more cautious next year, and then we'll wait and see what our January indicator trifecta has to say. That's always a big help. Santa Claus rally. Everyone's already been talking about it for months. They half the time they get it wrong.
Yeah. I was just gonna say. I mean, I feel like a lot of people are a little bit early on the Santa Claus rally, so maybe you can a lot early. Maybe you can go through the rules again, because again, it was your father, Yale Hirsch, that did come up with this concept initially, and so it has gotten. I mean, I don't remember the Santa Claus rally starting in November, but I mean,
or August or September when they start talking about it, or Halloween. No, and it's not a tradable rally. Not that you can't trade it, but it's not a trading strategy. It's an indicator.
Yeah,
it's the last 5 trading days of the year and the first 2 of the new year for the S&P 500. And if as my father, coined the phrase, if Santa Claus should fail to call, bears may come to Broad and Wall. There's usually a short, sweet rally, about 1.5% around that time, with, a lot of us taking some time off with family and friends and a little vacation or whatever, or having some holiday festivities. and there's a lot of office parties.
Hmm.
But the pros are still the trading desks, and they're picking up bargain stocks sold for tax loss selling. And there's generally a bullish vibe around the turn of the year, from Christmas through New Year's. And it starts this year on the close of the 23rd, so it'll be the 24th through January 5th, which is the second trading day. And if the market doesn't go up, then it's a sign that, there's trouble, that people are concerned about things. So Yale also invented something called the January Barometer, not to be confused with the January effect. The barometer is as the S&P goes for the month of January, so goes the year. The effect is a small cap thing. We can talk about that in a second. That's the small caps outperforming large caps.
Well, and then the number, the other part of the trifecta is your first 5 days, and
Which is old school.
okay, yeah, and you know what? It's funny because Jim Ropel was just on, and our show, he was sharing some data about when you have up years, especially the larger the up year you have, sometimes that first week in January can be a little rough, as some people are trying to just push their tax bill
Right.
a little bit further, and so he was like, "Be careful of that first week." How does that play into your trifecta?
So it does. I mean, and there has been a bit of profit taking in the new year. And we've also seen that through January. January's not as strong as it used to be. But people talk about the first week, and at the Almanac, we try to be extra specific about things. We're talking about the first 5 trading days, which I don't know where you're going to mark the week, whether it's Friday, January 2nd, or if it's this, the later that week, the 9th of the next Friday, but it's the first 5 trading days.
Yeah.
Okay. Which was something that was popularized back in the 40s. It's been around for a long time. It's been in the Almanac ever since the beginning. So we stand on Dad's shoulders. We came up with this about 15 years ago or so, where we combine all 3 of them: the Santa Claus Rally, the first 5 days, and a full month barometer. And the numbers are pretty amazing. It's all on page 20 of the Almanac, the 26th Almanac, which is out there. And in 29 of 32 years, when we hit the trifecta, when all 3 are positive, that's 90.6% of the time, the market is up for the year, and up 17.7% on average. So 29 of 32.
Wow.
Sizable data sampling, statistically significant, 90.6% of the time, 17.7% average gain for the S&P.
Yeah.
If any one of those, don't come in, the results are, muted a bit depending upon how much. If all 3 are done, all 3 fail, it's not great at all. But it really, the full month is most important because it's a greater, time span. It's not something less can happen in one short. More can happen in one short little week or one short little time frame.
Right.
And this year or next year, we have the next FOMC meeting on the 28th, if memory serves, just before the end of the month. So we'll get a lot of stuff packed in. And the reason the January Barometer exists is the lame duck amendment to the Constitution, the 20th Amendment, which moved newly elected Congress people into taking office the January after they were elected versus 13 months later in December. Hence, they were called lame ducks. Remember back in the old days, they had to take a horse and buggy from, Braintree, Massachusetts, down to D.C. to get into the Congress. So now things happen a little faster. So, and then also Inauguration Day was moved from March 4th to January 20th. We used to get the State of the Union in January. That's kind of shifted a little bit, but a lot of stuff gets set in January. A lot of policy initiatives, a lot of outlooks for the year come from from Wall Street, the wirehouses, the big analysts. So January trifecta.
Yeah, very good. And I realized I kind of went a little bit out of order in my charts. I pulled this one up with the sweet spot, and I had meant to show this one because as ugly as it was at the beginning part of this year, and as much as it was kind of not going the way you typically see things go, it really did kind of catch up and get right back in there, right?
Yeah, now we're like right above or at the green line, which is somewhere there in early December. Again, one of the reasons why I remain bullish for year end. We had mentioned briefly like December's got a little bit of its own internal seasonal pattern, where there's a little chop in the beginning from the aforementioned tax loss selling and that sort of thing. But end of the month, pretty strong. That's why the Santa Claus rally is there. That's why it exists. So this is normal, despite us having a little abnormal seasonal behavior in response to the negative, Liberation Day tariff tumble stuff.
Right. And I want to, you mentioned this a little bit, and I want to dive into this a little bit more because you did talk about the January effect, different from the January barometer. So maybe you can describe that a little bit.
Well, the January effect is the tendency, or was the tendency, for small stocks to outperform large stocks, small caps to outperform large stocks in the month of January. Our research has shown that most of that January effect now takes place in the last half of December, the last 2 weeks of December. So that's when it starts. You can see the Russell 2000 line is the maroon one, or the dark red, whatever you want to call that. That's
Right,
much
right
stronger
here,
than the
the
others.
solid one, right?
And the dotted. The dotted is
Okay.
post-election year. The solid's
Oh, I just
21
realized
years.
it's not showing up. 1 second, let me. There's my
Yeah, here
cursor.
we go. So, we have a chart that we show the Russell 2000 ratio versus the 1000, and you see that turn right around. It starts to bottom and turn where small stocks start to outperform around, Thanksgiving. It even begins a little bit in October. You can see the black line's the average there, but here we have we put this out right around Thanksgiving. We're just starting to take off, and you can see small caps made new high. I mean, the Russell 2000 made new highs today. Maybe we'll get a little bit of softness into mid-December, but for the most part, it looks like the sort of small cap seasonality is stirring, which is positive. I will say one thing that we didn't, haven't mentioned yet. The longer term history of small caps outperforming large caps, not looking at the seasonal aspect, but the small fry tend to, come into the game towards the end of the bull,
Okay.
So not that it's over yet, or we might get a little softness next year, but we've got the rate cuts helping the small caps, but just keep it in your mind that that tends to be the latter stages of the bull market when the small caps join the party.
Yeah, and I was gonna just again to remind folks that 2022 was very punishing for small caps. There's been this is our relative strength line here, and the relative strength for the small cap index Russell 2000 has been lagging in a significant way. This is a monthly chart that I pulled up, lagging the S&P 500 in a significant way. Now it's turned up recently, and you can see that in the price performance, but also a little bit in the relative strength. It's got some work to do. But yeah, when you start going into a daily chart, and look, there were a number of, or at least I felt, there were a number of these times where it looked like it was ready to go, and then it kind of it would break out and then it wouldn't go anywhere or it would reverse immediately. We did get kind of this trend earlier in the year, the latter part of the year here, where we just stayed above the 10-week moving average line, based a little bit, and as you mentioned, now, I mean, this is kind of a breakout today into new high territory. So
We need
since
some
we are talking
confirm
about
on
small
this
caps,
breakout, though, right?
it's what?
We need some confirmation on this breakout,
Yes.
though, right?
Well, I mean, that's the thing is we saw all these breakouts before on the Russell 2000, and you maybe get 2 days, and then it was like, okay, that was it, kind of. So with the Fed, again, the Fed just announced a rate cut today, and that was widely expected. There was a little bit of angst, I guess, after the last one because the last rate cut when
That's
Powell,
when the
in
markets
answer
fell
to a
off.
question, basically said, "Hey, it's not a lock, that we're going to have another rate cut here," and that kind of panicked folks and made the odds of a rate cut, really kind of go wild. But what's your take on the Fed action right now, and how do we kind of look at that in terms of what we feel the market may be doing as a result.
I mean, you can see by today's market reaction or market performance, it was a much more dovish cut than people were afraid of or fearing.
Hmm.
I think the Fed, is going to have to ease. There's this debt issue that they're going to have to be careful with, the government debt that's got to get paid, and that's no joke. But we're getting towards neutral. They said, I guess I saw that they're saying maybe only one cut, but some of the dot plot stuff next year. There's going to be a new sheriff in town pretty
Yeah.
soon, and there's going to be new data. So, I mean, I really think that that's the important part. I think the Fed needs to get back to the business of not jawboning and talking about what they're going to do and just being the guardrail that they were invented or created to be, and
Hmm.
go back to the Volcker days of just listening to the bond market and stop trying to dictate policy and comment on everything,
Hmm.
and just talk about the data that they're seeing. And if things get out of whack, they come in and they adjust things.
Yeah.
There's an old, quote from the minutes from the '81 where Volcker's, talking to the committee about, if the bond market gets out of the range of 15 to 21%. I mean, this was big interest rate numbers. Then the committee will come in and do something, as opposed to trying to lead it. And they probably need to reevaluate their models, considering how
Hmm.
they were late on the transitory inflation and maybe a little bit late on the cutting, this time around. So I think they need to stop giving speeches and talking about it so much. I mean, you can see Powell answers the question on the 29th that not a foregone conclusion, or whatever the exact quote was. Market drops. I have a chart where we just put a dotted line in there. And
Yeah.
then was it Williams down in Chile giving some talk, said, well, maybe it happens. The
Hmm.
futures, the CME Fed Watch futures flip, and the market turns the next day, turns that day on the Friday before Thanksgiving. So,
Yeah.
I mean, if that is not enough of an indication of the Fed, that the Fed should really not be in the business of making, projecting, and forecasting to the public, then I don't know what is.
Sometimes it feels like it's a test balloon that's thrown out there, and then you've got the other Fed governors that are walking it back if necessary, and if the
Maybe
market doesn't react nicely.
they've been accused of being political so much recently. Maybe if they just went back into their, labs or their databases and spreadsheets and studied the numbers and made, calculated decisions based upon what the bond market was doing, what the economy was doing, we'd be better off.
Yeah. And I mean, to your point, back in Volcker days, if I'm not mistaken, it was one of those things where there was no Fed announcement. It was just kind of,
Yeah.
it just kind of slipped under the radar. Yeah, you found out about it later. Well, you also bring up a good point, because you said maybe they need to go back to their databases and everything. And with the shutdown, of course, some of that data was missing.
Yep.
Now they were trying to fill in the gaps with some private company data, a lot of ADP for the jobs and everything like that. Now we're kind of getting the data. It's a little bit late. They're skipping some. What do you think that does to the Fed's decision making in that
I
regard?
mean, it may be good that they need to take it may reset things a little bit, kind of like a fast or something. I just the numbers of consumer spending and economic data seem pretty clear. You've got the jolts, or the claims, the new unemployment claims is the jobless claims is really important. That's held up. I mean, there's been some weakness there. I think the shutdown wasn't great for the country, the economy, but perhaps it was just a bit of a reset, and maybe they'll be a little more patient with the data coming in and not trying to talk up the market or talk up what they're going to do so much. So I'm kind of slightly encouraged that it might refresh. There might be a pause that refreshes.
I want to talk a little bit about Bitcoin. This is something that, as I was looking at some of your blogs and whatnot, you did make the point of how Bitcoin typically does in a presidential cycle, and the leading indicator. And there's something interesting going on with Bitcoin, and some people were saying that kind of caused this latest pullback, as there seemed to be a lot of deleveraging. So what's your take on that kind of relationship?
Um, I my point was that there's a lot of talk about what caused the market decline, and this deleveraging, with the sort of little tariff scuffle we had with China back was October 10th.
Hmm.
It definitely had an impact, but the Fed, I think, was more impactful if you look at that chart, or if you go back and look at that line in the sand. But it exposed the leverage for Bitcoin now. I think the luster's off with crypto. It's maturing. That chart that you threw up there of the 4-year cycle for the presidential cycle for Bitcoin, there's only four of each. It's not quite significant enough, though it is a little bit disconcerting that the midterm years are the weak ones there, and it does. I mean, Bitcoin has just proven to be tracking or even maybe leading a little bit the stock market with the sort of risk on, risk off sentiment. But it's kind of like the stock market, 2, 3, 4x depending upon the day. So it goes up and down more in either direction, whether it's you're related to the Qs or Nasdaq or Dow S&P. It's just a bit more volatile. I mean, you've got the midterm year. It's up 500% there at 2010. The data begins in July. It's not even a full, And look at the post-election year 2013, up 9,000%. I mean, it's kind of hard to take these that seriously. You got to take them with a grain of salt. I mean, just forget the amount. It's kind of like a positive negative. So we've got the 3 full midterm years are all down. This year, we're already down a bit. Perhaps it pulls some of that forward. But in general, the gains in these, instruments are not going to be as large as they used to be, as they had been. I think it's a little bit late. And seasonally, which I've done some work on with Bitcoin, it's not performing, which is a red flag for me. And we've actually exited our position in the IBD, the ETF, for a bit of a loss. But you take losses, before they
It's
get too
part of the
big.
game, right?
It is.
Well, okay. So before we get into some of the things that are on your radar, just kind of walk us through again a little bit of. You already mentioned that this isn't your normal presidential cycle. It's not. This isn't year one. It's really kind of year 5. Next year is kind of year 6. And what's kind of your projection for the 2026? You already mentioned the January things that we should look for that can help us gauge a little bit of what to expect. But what other things are you looking for besides the January Barometer and Santa Claus rally?
Well, I mean, we're looking to see if this market has the legs that it needs, and the trifecta, January trifecta, will give us an inkling if it's still got that momentum. There's, aside from what could happen on the geopolitical stage or some sort of exogenous event or some sort of even worse deleveraging from Bitcoin or crypto, you're looking to see what happens. I mean, in the election process, in the campaigning, does this get hot and ugly, and does it piss off or upset the market and the populace, where they're taking money out of the market and not just surveying that they're upset or concerned, but actually pulling out money. So you're looking for market behavior, market action. I mean, the country is bound to be disappointed by any president that was just elected. They're not going to be able to deliver on everything, and this is what creates that 4-year cycle. So you're looking to see how disappointed they might be, how the market behaves. I'm concerned that some of the impact from tariffs will start to take its toll next year. I don't think we've seen that yet. It remains to be seen if that's going to happen. I know the Fed chair was talking about when the impact of the tariffs wears off, inflation will come down more. I'm not so convinced. But but we're really looking at market action. I mean, the market is the final arbiter, is the real barometer of what's going on there. So, but any weakness sets up a buying opportunity. This is the middle two quarters, Q2, Q3, are that weak spot of the 4-year cycle where down S&P or down a couple percent, Nasdaq's down 6 or so, and it sets up that sweet spot, that big buy. I mean, Yale called the midterm year, we still call it that, a bottom picker's paradise, which sets up the potential for, about a 50% move in the Dow from the midterm low to the pre-election year high. It's about 66% for Nasdaq, and what you see is this weakness as the campaign trail heats up, and they're battling to maintain these thin margins that they have, the incumbent administration has in Congress, and there's going to be the mud's going to fly, and market tends to chop and go sideways during the middle part, the worst 6 months, the sell and May period of the midterm year, and then take off in the fourth quarter. So if we do get that weakness, back it up. This is going to be another great buying opportunity. So that's
And it's a good reminder that just like this year, it certainly didn't start out great, but here we are, as we showed in that chart, we really caught up to the average. It's a good reminder that a lot of times when you're looking at these numbers of, a 15% year or a 20% year, it's not linear, right? There's a lot of the pullbacks, and as you said, if you can get in on some of those opportunities with a pullback on some of that weakness, you can have some really big outsized gains. But what should people be looking at in terms of if that's going to transpire? What would kind of tell you, oh yeah, this is the direction? Because it's hard to do a lot of buying on weakness unless you've done selling on strength, right? Where you've got that cash available. So what kind of things would you be looking at in terms of, hey, this is maybe this weakness that we expect to transpire?
I mean, you keep track of our best 6 months switching strategy, best 8 months. You look for a MACD trigger to get out in the April to June period, and then you tighten up stops, limit new longs, and you wait through the weak seasonal period, which admittedly didn't transpire this year, but I suspect it will next year. And then you're set up for that big buy signal around when we get another technical trigger at the outset of the best months in October. So it's not perfect. It's not easy. If you're going to be trading this, you need to stick to the system. I think the seasonal cycle can help you. I think overlaid with the technical indicator of MACD, if you want to use something else, you can. We like to use MACD. I think that helps you. I mean, it did it for us in 22. We were out by the time we got to our sell signal in April of 22. Most of our stops had been hit in our portfolios, as we tighten things up in the stocks and ETFs. And, you'll see the tape itself telling you that the market's weak here. So, and then that it's time to just sort of keep the bat on the shoulder, wait for that fatter pitch, and wait until you get through that election cycle, and you start to, the midterm election cycle, and you start to see the market, gaining some traction. So I don't think next year's gains are going to be anything like this year's. I think we're going to keep it high single, low double at best. 8 to 12 is what I'm looking at, year over year. But that's what happens in a midterm year.
And hey, that's still, again, if you are compounding on some great years, that can still make a very big difference. And it's important to remember, again, you give all these stats, and by the way, someone in the YouTube comments was talking about how much they love their Trader's Almanac. I think it's our good friend Nancy here. But yeah, I want to make sure that I also let people know where to go. Because in addition to the Almanac, which I think a lot of people agree is a great tool to use to get those statistics, you can actually kind of do a backdoor way of getting the Almanac by signing up for your blogs and everything like that, going to the website stocktradersalmanac.com, right?
Yeah, I mean, it comes free with a subscription to the newsletter. If you go to the website stocktradersalmanac.com, there's a little get STA tab in there. There'll be a discount, promo code in there for getting that, and the book comes free every year to subscribers. One of the
Mhm.
things I wanted to mention about the midterm, year, and everyone's concern for the bearishness. A lot of people are talking about it now. I'm seeing charts posted and people talking about their concerns for next year, and I start to get my contrary antenna purring that maybe it's not as bad even as I initially thought in my outlook for that's in the book. But and we'll be putting our full 2026 annual forecast together in the upcoming January outlook annual forecast issue of the newsletter. Should be out on the 18th, if that's the Thursday of
Mhm.
December.
Um, Before we go, I also want to kind of cover some of the areas that you're looking at and paying attention to. Something that has been really interesting. Here's one name that you gave me: Collegium Pharmaceutical.
Yeah.
The medical generic drugs, biomed, biotech. I'm just going to throw up XBI. I do have a position in XBI
Yeah.
myself, but
I have
for
one in Collegium.
yeah, so Collegium is, a really strong day today, a big outside day, closing at the top of its range. What is it that what is it that you're looking at here?
I mean, we do a fundamental screen right around the beginning of the best 6 months. We did it early in September because the market was so strong. So this came through our fundamental screen. We're looking for modest relative strength, increase acceleration of revenues, a growth of revenue and earnings, good valuation. So back in September, the numbers were looking good as it came through our strings, and then technically we picked an entry level. So we also want stocks that are underfollowed, that when whatever it is that the screens are seeing become appreciated by the industry, other analysts will jump on. So this is one of those that it was a small cap that came through on the fundamental screen at the seasonal time of the year, and popped pretty recently. I think their recent earnings numbers were kind of what drove it, with their ADHD drugs and their pain management drugs. Um, so yeah, pretty solid little pharmaceutical company. Um,
Yeah, so in addition to the broader, I guess, medical, biomed, biotech trend, again, there have been a lot of them that have been really moving strongly. There's also, gosh, pick your mining metal. You mentioned copper, but you really could
yeah,
be looking at GDX, the gold miners, steel, SLX. That's been strong. Coal to a certain degree. I mean, XME, which is your mining and metals ETF. This is looking set up. But let's talk a little bit about COPX, which is the Global
right.
X Copper Miners. What is it that you're looking at here?
I mean, this is a seasonal trade. This comes out of the sector seasonal strategy calendar in the Almanac. You mentioned GDX and gold. Fourth quarter gold has been a you know staple in the Almanac for a long time. It used to be ASA gold is what they used to trade in my father's day. So
Hmm.
we took some profits in the miners and the junior miners, and I believe we just tightened up our stop on the GLD itself because the seasonal period's ending. Not that there's not a macro and fundamental trend there, but seasonally we trade these sectors that way. So for copper, copper tends to bottom in December, as the sort of construction cycle is at its low, and it's a seasonal trade we try to get into every year. And we got in a little bit early because it looked like it was setting up, and I own the COPX. I didn't personally pick up the CPER, the copper, the other ETF, but that's what the other one that's on our newsletter trading list. So I do like stocks. So the COPX is a
Hmm.
good ETF for me, and it's just also on top of the data center build out and all that stuff.
Right.
It just it plays into that as well as the seasonal trade. Nice setup technically here. So a combination of the seasonal fundamental and I guess macro trend.
Yeah, and SCCO, which is Southern
No,
Copper. This is one
yeah,
that is on. this is on our leaderboard product. You had FCX, Freeport McMoran, that had a
Yeah,
strong day
these are a
today.
couple of stocks that we have traded that correlate very well with the seasonal trade. Both of these, Freeport and Southern Copper. I'm glad you brought those up.
hmm And then we can go ahead and finish up with a look at IYT, which is the transportation. A few areas here, I mean, whether it's the truckers like JB Hunt, I was noticing that had just took off in the last few weeks here. You also had jets. A lot of the airlines
That's
really
the
moving.
Frank's ETF. Yeah.
hmm So yeah, let's talk a little bit about IYT and what it is that you're looking at here. Is there a seasonal aspect to this as well?
Yeah, I mean it's a seasonal aspect. It's a December, bullish season begins. There's been some talk here about Dow theory as well, where if you go back to maybe you pull up your monthly chart, I think it's breaking out to or about to
Yeah,
break out the new long term, even longer term highs. Yeah, I guess that's the
yeah. It poked
2020.
its head in 2024 and
Yeah,
then
so
based
this is
again. But
some of our technician friends have been pointing this out, and then if you get the transports making a new high on top of the Dow, the industrials, that's an old school Dow theory confirmation of more bullishness. But it's a seasonal trade, again breaking out to new highs. A lot of stuff's getting shipped around. I got to get my deliveries.
mhm,
For all my stuff that I got to buy.
yeah.
But you're
Um,
seeing it yourself in the trucking stocks and the shipping stocks.
yeah. Actually, I was just going to say, some of the areas that were also kind of coming up in some of my screens were the oil and gas has been a little bit tricky lately, but the shipping, the transportation of oil and gas, seems like that's been a little bit
Isn't
stronger.
Amazon like a transport now too? With all
It
the
might,
deliveries that it makes?
it might be.
I got
Excuse
you.
me. Yeah. So yeah, it's funny how some of those work. I think like Uber is in the is in the industrials and things like
Right.
that. Some stocks that you would think of as tech, they have this exposure elsewhere too. So yeah, it's tough. But okay, just again, one more reminder for folks because again, I think you put out a lot of great content. So if folks aren't following you on X at Almanac Trader
Hmm.
is the follow on X. You put a lot of great stuff out
Thank you.
there, and then also stock traders almanac.com, and of course there is the stock traders almanac itself that comes out every year. A lot of great information and just it's just fun to have that like right on your desk. It's one of those things when you're like, huh, I wonder what usually happens. You've got tables, you've got all sorts of data that people can look at, and then of course you do a great job with your blogs and your presentations. So that's one of the benefits of the newsletter. So final thoughts from you, Jeffrey.
Appreciate the kind words there, my friend. Again, watch out for the Santa Claus rally. Don't necessarily try to trade it. See if it comes in. The January trifecta. Small caps are coming into play right here. We have a only free lunch on Wall Street trade that we put out to subscribers with stocks making new 52-week lows on Triple Witching Friday in December the 19th. So that's a little trade if you're looking for something. And again, next year, try not to be so bearish. Maybe a little chop sideways, some pullback in the middle of the year, but I don't know. We're in a big AI tech super boom, so you
Yeah.
know,
Way
stay
to
on
bring
it.
the holiday cheer, Jeff. That's awesome. Thank you so much for being here. Really appreciate it.
My pleasure as well.
Take care. That's going to wrap it up for us this week. Thank you so much for watching, and please join us next week. We're going to have a brand new guest on. He is very familiar to a lot of IBD followers. He's been a IBD meetup leader for a long time on the East Coast, so you might be familiar with the name Greg Morton. He also does some great posting on X, so please join us for that. We're going to be live at 5 as usual. So thank you very much for watching, and we will see you next week. Take care, everybody.